Hello everyone, and welcome to our first webinar of this season by Finvision. I want to welcome everyone who is taking an hour and a half out of his time to be educated on today's topic, intangible assets, IAS 38. Some of you may already know that we already had a webinar on this topic. So today we will just do a recap on some of the basic requirements. Then we'll dive deeper into two specific topics of the standard. The first topic, which will mainly be presented by my colleague here, Lieselot, will be the internally generated development costs. The second topic I will tackle myself, and that will be the impact of cloud computing and software as a service on the intangible assets. So, speakers of today are myself, Andres Hennebelt, manager here at Finvision, and my colleague, Lieselot van Voeren, also a manager here. For those of you who are new, maybe just a very quick recap on the logistics for the webinar. So all the participants are muted. We will be the only ones you can hear talking, unfortunately. The webinar should last maximum 1.5 hours, so you can all enjoy your lunch afterwards. Questions, however, can be asked through the webinar app. If you can address them to the host and the panelists together, we will make sure that it gets answered now or shortly after the webinar if you don't have an immediate answer. There will be a short poll to evaluate our webinar, so please, if you do have any feedback or input, feel free to fill that one out. The webinar will also be recorded for your colleagues who didn't make it on this specific time slot. It will be available on our website and also on the YouTube channel. And for those of you who want to follow by yourselves on the slide deck, we made a PDF available under the handouts section of the GoToWebinar app. If you are not able to find it, please do shoot us a question and we'll make sure that it is available. Shortly on our Finvision Academy, the webinar series. So the first one today, intangible assets. Next up will be IAS 19, employee benefits, also a topic we already had in the past, I think, but we're going to dive deeper into a few of the details there. Same for IFRS 16, the leases, because there's really a lot of details we can go further into those, so stay tuned. And in December, of course, the IFRS updates, which will encompass not just the IFRS updates, but also if there would be any new guidance on the ESEF or on the European Common Enforcement Priorities, we'll let you know on that date. So we hope to welcome you then also. So as I mentioned today, IAS 38, the intangible assets, a very quick recap on the definitions, recognition criteria and measurement, and then our two main topics of today. I wanted to come back to this slide, a very basic slide, but intangible resources. Those are actually quite broad. Most of you have companies that have a lot of intangible resources, so scientific and technical knowledge. They are resources, whether they are patented or not. Same goes for the design and implementation of your processes, of your system. Those are the classic examples: computer software, IP, market knowledge, even market share can be one. Trademarks, brand names, goodwill, your workforce, training for your workforce, broadcasting rights. So those are really a lot of intangible resources we need to take into account. Just to make a careful distinction, not all these resources also meet the definition of an intangible asset. And that's why we wanted to go back to these basic definitions. An intangible asset is an identifiable but non-monetary asset without physical substance. I think this far everyone understands, but an asset is also a resource that should be controlled by an entity as a result of past events. And you'll note that, yeah, the word control here, a lot has been written about it in IFRS, so it will also be quite central to our webinar here. In order for a resource to become an asset, it should also be the case that future economic benefits need to flow to the entity. If you can't make money or advantages from your resources, then it won't be considered as an asset. And as you note on top, I also highlighted the word identifiable, because an asset is only identifiable if it's either separable or capable of being separated from the entity. So usually that is the case when it arises from contractual or other legal rights. So very important to make that distinction in order to fulfill your definition of an asset. Control, again, very central here, the power to obtain future economic benefits and restrict access of others to those benefits. We'll go deeper into what it means for like software as a service and how you need to evaluate control there. But another key definition for intangible assets will be for the measurement base, and that is your cost. So basically the amount of cash or cash equivalent that you have paid or the consideration given to acquire the asset at its time. So I think most of you know what these definitions are, but it's always useful if they're just summed up at the beginning. So with this very short introduction, I will give the word to my colleague Lieselot, who will talk you through the first main topic and just some general recap on the recognition criteria first.
Thank you, Andres. So indeed, the next topic is the recognition criteria. So an intangible asset shall be recognized if the following three criteria are met. So the first one is it needs to meet the definition of an intangible asset. As Andres has just discussed, the definition is it needs to be an identifiable non-monetary asset without physical substance. Secondly, it needs to be probable that expected future economic benefits will flow to the entity. Very important, or the key word here is probable. And then thirdly, the cost of the assets can be measured reliably. So that is the third condition that needs to be met to be able to recognize an intangible asset. Maybe to zoom in on the word future economic benefits. Future economic benefits, they do not only include future revenue from the sale of products or services, but it can also include cost savings or other benefits resulting from the use of the asset by the entity. So an example, if you use intellectual property in a production process, that will reduce your future production costs rather than increase your future revenues. On this slide, some examples that do not fully meet the definition of an intangible asset. The first one is the assembled workforce. So if we look to a company, we say, okay, individual employees, they have an employment contract with the employer, but the collection of the employees, so the assembled workforce, as a whole, they do not have such a contract. So it means that the assembled workforce is not considered a separable resource. We cannot sell it or transfer it or license it on a separate basis. So that is why it does not meet the definition of an intangible asset, and we cannot recognize that separately from goodwill, for example. The second one, internal goodwill. IAS 38 also explicitly prohibits the recognition of internally generated goodwill, also because it is not separable. It also does not arise from any contractual or legal rights. So we do not consider it an identifiable resource which is controlled by the entity and which we can recognize on our balance sheets. Then internally generated brands, mastheads, but also internally generated customer lists and market share. These are all different examples of intangible resources, but which we can also not separate from the cost of developing your business as a whole. So again, it does not meet the identifiable criteria, and so we can also not recognize those separately as an intangible asset. And then the last one, advertising and promotional activities. They also do not qualify for recognition as an intangible asset because their purpose is to create or enhance the internally generated brands or customer lists. And as we have just discussed, those can also by themselves not be recognized as an intangible asset. On the next slide, you can see some examples that often do meet the definition of an intangible asset. Because they meet the definition of the intangible assets, we can also often measure the cost reliably of those items. and it is also probable that future economic benefits will flow to the entity. You can see examples, marketing related, for example, trade names or brands, but it can also be customer lists, licensing agreements, patented, unpatented technology. So you can see a whole bunch of examples that we often do see in practice that meet the definition of an intangible asset. Next, we have an illustration, let's say a small case. So we have the ABC marketing agency, which is a marketing firm that provides advertising and promotional services to various clients. And one of their clients, XYZ Corporation, has recently launched a new product, and it has engaged ABC marketing agency to create a marketing campaign to promote that new product. Within that campaign, there are various advertising and marketing activities included. And the first one is the creative content. So ABC marketing agency has hired designers, copywriters to create some advertisements, videos, and all sorts of promotional materials for this new product. So they try to invest in all sorts of creative content to capture the attention of the target audience. The question is here, does this creative content meet the recognition criteria and the definition of an intangible asset? Well, the answer here is no. It does not meet the criteria for recognition because, as we have discussed before, it's related to promotional and advertising activities which have the objective to create an internally generated brand or an internally or customer relationships, let's say. So we cannot see those separate from the cost of developing your business as a whole. That is why it is not eligible for capitalization. We cannot put an intangible asset on our balance sheets, and we need to expense those costs as we incur them. In this same case, we also have a second part. So we have the company XYZ Corporation, who also within that campaign also decides to register a unique brand name and logo used in the promotion of their new products. And for that registration, they engage in legal counsel. They also incur costs to file for that trademark registration. And here the same question, okay, do these types of costs, are these eligible for capitalization as an intangible asset? Well, in this case, it is very probable. So the trademark registration costs can meet the criteria for recognition as an intangible asset if the company has the legal rights over the trademark, if they can demonstrate the ability to generate the future economic benefits, and which is also reliably measure the costs associated with the registration. So this illustration is just, we wanted to show you that you can have one transaction, you can have one campaign, which can contain multiple components. And so you need to evaluate each component on a separate basis to evaluate if they meet the definition and the recognition criteria of an intangible assets. And the conclusion can then be that, okay, some costs within that campaign will need to be expensed as incurred, but others can qualify for capitalization. The next topic is measurements. If we look to the measurement of separately acquired intangible assets, IAS 38 states, okay, that intangible assets shall be measured at costs. And what needs to be included in that cost? Well, that is first of all the purchase price, but this also includes, for example, import duties, non-refundable taxes, also takes into account discounts and rebates, if that is applicable. So in general, any directly attributable cost of preparing the asset for its intended use needs to be included in the cost basis. Which costs are not included? For example, if you have costs for feasibility studies, costs for staff training, or other general or administrative costs, these cannot be included in the cost basis of your intangible assets. Deferred payment, if you, for example, have purchased an intangible asset and you need to pay that intangible asset in future installments, then you need to calculate the present value of those deferred payments, and this then needs to be included in the cost basis of your intangible assets. So I think now for the first part of this webinar, we have discussed the general definition, recognition criteria, and the measurement of the intangible assets in IAS 38. But now for the remainder of the webinar, we will focus on a more in-depth analysis of the internally generated intangible assets, and then later on also the cloud computing arrangements. So the first one is the internally generated intangible assets. A small recap here. So we have already discussed it before, the internally generated goodwill, but also internally generated brands, mastheads, publishing titles. Those expenses cannot be recognized as an intangible asset because we cannot distinguish them from developing your business as a whole. So we do not consider them as an identifiable resource which we can recognize as an intangible asset. However, it doesn't mean that there can be internally generated resources or costs which can qualify as an intangible asset. So that is why for the following slides, we will focus more on the R&D expenses. First, as an introduction, some examples of research activities. So research activities being activities aimed at obtaining new knowledge, can also be new research findings, looking for alternative materials, products, or processes. So it can be all these different types of activities. What is the definition? Research activities is the original and planned investigation undertaken with the prospect of gaining new scientific or technical knowledge and understanding. The research activities, if we look back to the criteria, so the recognition criteria of an intangible asset, we can say, okay, research activities are performed in a very preliminary state of a project. And at that point, it will not yet be probable that future economic benefits will flow to the entity. That is why IAS 38 states that, okay, expenses related to research activities need to be recorded in profit and loss when incurred, because the recognition criteria of IAS 38 are not met at that point. After research activities, we often have development activities. Development activities, it is the application of the research findings or other knowledge to a plan or a design for the production of a new or substantially improved material, product, processes, but before the start of the commercial production or use. So these development activities will be performed in a later stage, so after the research activities, when there's already a more concrete plan in your projects. And IAS 38 states that, okay, expenses related to development activities should be recognized as an intangible asset if 6 criteria are met. And what are those 6 criteria? You can see them on the slide. So the first one is a technical feasibility. So it must be technically feasible to complete the intangible asset so that it can be used or sold. Second and third, so management must both have the ability and the intention to use or sell the intangible assets. The fourth one is generate probable future economic benefits. So important for this, there needs to be a market for the intangible asset or for the outputs so that it can create future economic benefits, or the asset must be used internally. The fifth criteria is the availability to adequate technical, financial, and other resources. So as an entity, you must have adequate resources to be able to complete your development and then eventually use or sell the intangible assets. And then the sixth and last criteria is the ability to measure reliably the expenditures. So as an entity, you must be able to reliably measure your costs, which are directly attributable to your project or to your assets during its development. So these 6 criteria are very important, and it's most importantly to determine that the concept that you are developing will indeed work, and that it will be probable that future economic benefits will flow to the entity. Some examples of development activities, as you can see on the slide, it can be design, construction, testing of prototypes. It can also be design of new tools, which includes new technology. It can also be the design, construction, and operation of a pilot plant, or the testing, construction of alternative products or materials. So all you can see can be very different sorts of activities. Available evidence that the criteria are met. So as we have just discussed, development expenses need to be recognized as an intangible asset if the 6 criteria are met. But it is, however, very important that you can demonstrate that those 6 criteria are met. So you need to have sufficient supporting evidence or documentation. And some examples are included here on the slide. So for example, the business plan. If you have a business plan for your project, which shows your technical and financial resources which you need for the project, and also the company's ability to secure those resources, that can be a very important set of information to support that the criteria are met. Also important can be if you have availability of external financing for your projects, or if you have different parties who already committed to having the willingness to fund your projects, can be very important. And then last, detailed project information. If you have detailed project information and you have also very good internal systems to be able to track which are the directly attributable costs that relate to your project, that is very important. So if you, for example, have your personnel working on a project, it can be very important to have a good time registration system, to have time cards, so that you can clearly identify, okay, that person has worked for so many hours on the project, so that part of his personnel costs need to be allocated to the project or need to be allocated to the internally generated intangible assets. The next topic, future economic benefits and cost basis and the measurement basis of the internally generated intangibles. So as we already discussed a few times, so one of the most important recognition criteria for an intangible asset is that it needs to be probable that future economic benefits will flow to the entity. But how do we now translate that into practice? Well, we need to perform a sort of cost-benefit analysis. And the result of your cost-benefit analysis should be that the present value of your future economic benefits should exceed the costs of your project or of your intangible assets. That cost-benefit analysis needs to be performed using the principles of IAS 36, being impairment of long-lived assets. So in other words, you need to perform a discounted cash flow model. So you need to create a discounted cash flow model for your project, and you need to get an overview of all the future expected benefits and costs of your projects. What will be the impact on sales? What will be the impact on EBITDA? And then based on that discounted cash flow model, you can perform that cost-benefit analysis, and you can prove that your project will, in a probable way, create future economic benefits for the entity. On this slide, you can see an overview. So if we have a project, what are the different phases that we have in a project? So as you can see, we always start with a research phase. So in that research phase, like we discussed before, it is done in a very preliminary state of the project. And at that point, it is not that probable that you will have future economic benefits from your development, from your new product, etc. So that's why you cannot, these costs are not eligible for capitalization. And so these research activities, they need to be expensed as incurred. After the research phase, we have the development phase. We also discussed if the development activities meet the 6 criteria and it is technically financially feasible, all the criteria are met, then these costs need to be capitalized as an internally generated intangible asset. I think here it is clearly stated, okay, you have the research phase, you have the development phase, but I think in reality, in practice, it's not always that easy to define, okay, where does the research phase end and where does the development begin? So if you have some expenses and it is not yet clear, okay, do they meet the 6 criteria for recognition, then you just need to assume that they still relate to research activities and you need to expense them as incurred. After the development, you can see on the slide, there's a vertical line. This actually represents the commercial launch of your products. So it means that your internally generated intangible asset is completed and you are able to commercialize the asset or the product related to the asset. And you can move over to the production stage. I think here it's very important. I think IAS 38 states that due to the nature of an intangible asset, in many cases, you don't have any additions to the asset after the commercialization. And that is because if you have subsequent expenditures, it is more likely to maintain the expected future economic benefits resulting from your existing assets. So it will not be in addition to your existing assets. It will also be very difficult to distinguish those subsequent expenditures from the developing of your business as a whole. So I think in general, it will be very rare that you will have subsequent expenditures of your project after commercialization that can still be recognized in the carrying amount of the assets. It will mostly be maintenance expenses, and those expenses need to be recorded in the profit and loss when they incur. The cost basis. So what is the cost basis of an internally generated intangible assets? So well, it is all directly attributable costs necessary to create, produce, and prepare the asset to be capable of operating in the manner intended by management. So what is included in that cost basis? It is the cost of materials and services used, also cost of employee benefits, also fees to register legal rights or patents, and also the amortization of those patents and licenses which are used to generate the intangible assets. Which costs are not included in the cost basis? So selling administrative costs, they cannot be included in the cost basis. Also not if you have, for example, a pilot plant and you have incurred some initial operating losses, some inefficiencies, also training costs if you have a new tool and you need to train your staff. These are all costs or expenses that you cannot include in your cost basis because there's no direct link with the future economic benefits that will flow to the entity. It is more the general link to developing your business. On this slide, it's a summary of the things we have already discussed. So as already said, okay, expenditure related to research activity will not meet the criteria for capitalization and we will expense them as incurred. This can also be the case for a part of development activities. But as soon as development activities do meet the 6 criteria, then you need to capitalize those expenses as an internally generated intangible asset, and you need to amortize that intangible asset over the useful life. And in case that at a certain point the costs incurred on your project exceed the benefits, then it can also be possible that you need to record an impairment. Some challenges in recognizing costs for internally generated assets. I have summed up a few of those challenges. So the first one is allocating costs incorrectly. So I think it can be very challenging. So if you have a project to determine precisely which costs are directly attributable to a particular project, especially if you have multiple projects which are ongoing simultaneously, it can be very difficult to really allocate or determine which costs are allocated to a specific project. And of course, if that is done incorrectly, this can lead to over or undercapitalization of certain costs. The second one is external costs. It's a bit related to the first one. So if you have a project which also involves external parties, external contractors, it can also be very challenging to accurately measure and allocate the costs of these third-party services. So as a company, you need to make sure that you have reliable processes for also tracking and attributing those external costs to your relevant projects. The third one is lack of clear criteria. Also important, so as a company, you need to establish clear and consistent criteria for what qualifies as a capitalizable cost during your projects. Because if you have not defined that very clearly and the criteria are not clearly communicated in your organization, this can lead to confusion and, for example, capitalization of general and administrative costs, which we do not consider directly attributable to the projects. Another one challenge is the failure to document the costs. It's very important that you have proper documentation of your R&D costs, because you can, if your costs are not adequately documented, it can be very challenging to demonstrate to, for example, auditors or regulators that these costs are directly attributable to the development of your assets. So just always make sure that you have sufficient and thorough documentation which support your capitalization decisions. Another challenge is estimation uncertainty. I think inherently R&D projects, they often involve a lot of significant uncertainties, especially in the early stage of the project. So it can be quite challenging to estimate, okay, what will be my future benefits? What will be my costs related to that project? So as a company, just make sure that you use reasonable and supportable estimates. And of course, also linked to the previous item, that you make sure that you document it thoroughly to support your decisions there. And then the last one, periodic review and reassessment. Just make sure also that you periodically review and reassess your capitalization decisions for your ongoing R&D projects, because circumstances can always change. And if your project's expected benefits are, for example, lower than you initially expected, then it also needs to be necessary that you adjust your capitalization of your costs accordingly. So these are some challenges, some pitfalls that you really need to be aware of when you have such an internally generated intangible asset in your company. Next, again, a small illustration or a case. So we have Fin Pharmaceuticals. It is a leading pharmaceutical company engaged in research, development, and manufacturing of innovative drugs. They have an ongoing project to develop a groundbreaking new drug for a rare medical condition. And throughout the project, Fin Pharmaceuticals has incurred different types of personnel costs. So it incurred personnel costs for research scientists, for laboratory staff, for financial controller, also for a scientist who performs drug tests, a marketing sales manager, and then also an employee cleaning the laboratory equipment. So in this case, the question is, okay, which costs, which of those personnel costs can be eligible for capitalization during the project? If we look first to the research scientist, the research scientist, also if you look to his job description, he is 100% focused on research activities. And as we already discussed a few times, research activities need to be expensed as incurred. So these cannot be capitalized during the project, and we need to consider those as operating expenses. Laboratory staff, are those costs eligible for capitalization? Well, that depends. So if you have personnel who is working on very preliminary laboratory research, which involves discovery of new ideas, new possibilities, well, then that is research related, so that needs to be expensed as incurred. However, if your laboratory staff is already working during the development phase, so if you already have a reasonable expectation that your project will succeed and that it will generate future economic benefits, then of course those development expenses can be capitalized or need to be capitalized during the project. The financial controller, no. So the personnel costs related to the financial controller cannot be capitalized because they are considered general and administrative overhead costs, and they are not directly attributable to the development of your intangible assets. The scientist performing drug tests, again, here it depends. So if you have, if the drug test relates to an early stage drug screening activity to identify potential candidates or assess their feasibility for future development, then we consider this as a very preliminary research activity, and then those costs need to be expensed as incurred. However, if the drug tests are already in a very more advanced phase of the project and it relates to testing and regulatory compliance related to the development of the drug, and the 6 criteria are met, as we have discussed, then those personnel costs of the scientists need to be capitalized in the intangible assets. The marketing and sales manager, no, marketing and sales manager and the personnel related expenses cannot be capitalized because they are not considered directly attributable to the development of your intangible assets. So these need to be excluded. And then the last one, so the employee cleaning the laboratory equipment, the personnel cost of that employee can also not be capitalized in the intangible assets because the cleaning of the laboratory equipment is considered a routine maintenance work. And it is considered an ongoing operational expense, which is not directly attributable to the development of your intangible assets. So I think in general for this illustration, it is related in the pharmaceutical sector. And I think in that sector or industry, the capitalization of development costs for new products or processes usually only begins at the date when the product or the process has received regulatory approval. And so in most cases, that will be the point when the IAS 38 criteria for recognition of intangible assets are met. And it's very unlikely that those criteria are met before that regulatory approval has been granted by the regulator. To wrap up this topic on internally generated intangible assets, we also wanted to mention the SIC interpretation that is published on the website costs. So that interpretation mentions that, okay, website costs can be eligible for capitalization as an internally generated intangible assets if they meet the general recognition criteria of an intangible asset, but if also the 6 criteria of the internally generated intangible assets are met. So that's the general rule. But I think here the difficulty or the main conclusion in this interpretation was that you should be able to demonstrate that your website is directly used in the income generating process. So for example, if your website or your website costs relate to a web shop, then you can easily demonstrate, okay, that web shop has a direct link to my income generating process. So you can generate revenues due to sales of your products through that website. And those costs can then be capitalized as an intangible asset. But if you, for example, have a website and the only purpose of your website is to promote or advertise your products, but it is not linked to a web shop or the ordering of your products, yeah, then it's very difficult to say that the recognition criteria are met, because we have mentioned it already a few times. Promotion advertising expenses do not meet the recognition criteria. It's just considered as expenses to develop your business as a whole, but there's no direct link with your income generating process. So I think that's the main conclusion. I think for websites, for website costs, you need to be able to demonstrate that it has a direct link with your income generating process. Okay, so this were the slides related to the internally generated intangible assets. For the next topic, I will give the word to Andres, who will discuss more about cloud computing arrangements.
Thank you, Lieselot. So, our second big topic of the day, cloud computing arrangements. just again, we're gonna start with basically an introduction, a recap, and a bit the scope, let's say. But as an introduction, yeah, I think everyone knows cloud computing is just getting everywhere a lot of extra popularity. I mean, if you look at it 15 years ago, main software licenses were licenses that you bought for a number of years and you could get a few updates here and there. But today, a lot of the software as a service, you're really only getting access. The hosting is no longer done at your own premises, but the supplier makes sure that everything runs smoothly, and you just need to get a terminal basically to access the software, but any computer can do that. So there's really a lot of technological change. Data and connectivity has really increased by a lot. So yeah, that's the reality in the business that has been seen over the last years. Now, the difficulty there was until a few years ago is basically the IFRS guidance. It hasn't changed. You can apply the current IFRS guidance to cloud computing, but apparently there was a lot of diversity in practice to how it was being implemented. So what the IASB did is they made two different agenda decisions, basically, where they confirm how for a number of specific cases, let's say, the facts and circumstances, how do they see the current IFRS rules and how should you try to interpret them? Those are more guidelines you should try to follow because they're basically also specific to the cases that have been treated there, but they do give us a decent hold on how to start there. Maybe for most of you, a few examples of cloud computing arrangement. Mostly known are the software as a service contracts. We will also be focusing on these. Those are usually the biggest for most companies. But like examples of these are Microsoft 365. Most of you who work in Office, Word, Excel, etc. Those are often no longer locally installed programs, but more of a subscription-based, where you just get the current version. It's always up to date or being updated within a number of days or weeks even. And yeah, it's really more of a service than it's still a subscription to a license. Salesforce is another example. But yeah, we also have the other common types, infrastructure as a service. So Microsoft Azure, Amazon Web Service perform a lot of the infrastructure, but also platform as a service with the Google App Engine, database as a services for those of you who tend to use SQL. Those will certainly know the Azure SQL database. Now, if we focus on the most used here, software as a service, which is also the topic of the agenda decisions there. First thing they opened with in explaining is basically watch out in what IFRS or IAS standard you are working. Because first question you should ask yourself, does the arrangement contain a lease in the scope of IFRS 16? If yes, obviously, we will treat the accounting and the recognition under IFRS 16. If that is not the case, we'll go back to reviewing, for this webinar, obviously, the basic definition of an intangible asset. So does the arrangement provide a resource to the customer that can control? Again, control is the central concept here. If it's yes, then we'll need to account for it under IAS 38. Now, if you do not have a lease and you do not have an asset you can control from this, usually you have a service contract. And that is the basic implementation that has been added there with the agenda decisions. If you have a service contract, no assets will be capitalized here and you will just try to expense everything through P&L. I think the difficulty in the intangible assets here is to really try to measure control. I mean, it's not always easy to say, do we now have control over the software here? And sometimes for me, it helps if we also try to do the inverse of our exercise and try to see, okay, if we have control, for example, IFRS 16, we have decision-making rights on the underlying license of what we are leasing here. That should also mean that the lessor or supplier here has given up those decision-making rights. Those two conclusions should always be in sync with each other, obviously. So if we have control, the supplier no longer has control, or the other way around. Like for example, Microsoft 365, I think for most of it, it would be really hard to show that we have control over that asset, because basically we can't decide when there's an update or what we do with it. Really difficult case there. So just to go a little bit more into detail on the first agenda decision, it was from 2019, so it's already a while ago. And the basic topic here is really the license fees that are being charged for the software as a service. So basically what they confirmed there is that under the current IAS guidance, a right to receive future access to the supplier's software, even though he's running it on the supplier software's cloud infrastructure, it does not in itself give the customer the power to obtain future economic benefits from the software itself. So you're using it within your company, but that does not mean that you have the rights to the underlying software itself. And that's really key distinction there. They also mentioned, it's because you don't have the underlying software itself, you can't restrict others' access to those benefits. So again, a key factor here, decision-making rights, how and for what your software is being used. The basic control definition here is if you do not have control, those license fees will have to be expensed as incurred, as for all service contracts. Of course, if you do have a number of large upfront payments that you do, these might need to be accounted for as prepayments. That's not IAS 38, that's just your basic accounting there. So it might be that there is an asset, it just won't be an intangible asset, and it won't show up as a depreciation in the P&L, let's say. Maybe another distinction, when you're accounting for a service contract, make sure that you try to separate software and hardware costs, because generally, if you buy hardware which you will be using to access the software as a service, that would generally still be capitalizable under IAS 16. The main item to remember here is if you use a terminal or a computer, even if it's only to access that software as a service, you still have control over those. You can use them to do other tasks within your company, and that's at your own discretion. And that's what indicates control there. So you can still capitalize the hardware parts of certain contracts, even if the remainder of it would be a service contract that has to be expensed. So here I just want to go back to the basic definition, where you see, okay, your intangible asset, it's only a resource, has to be controlled by your entity before it becomes an asset. Why do I throw back to the definition we have already seen before? I think the main point is if you're going to go looking into the CBN advices for Belgian GAAP accounting, this distinction is not made. If I translate the CBN advice literally, they speak of company resources. So resources, not assets. Since the agenda decision here is really pivoting on the definition on controls, we will make sure that a number of these control aspects need to be followed, but it will not translate into the Belgian GAAP accounting. So this might be a difference between your IFRS books and your Belgian GAAP books. So please do be aware of that. If you're expensing it under IFRS, that doesn't mean that you should also expense it under the Belgian GAAP guidance. I think, yeah, the main difficulty we need to get back here is the control indicators for software as a service. If we look at the guidance that is available there, there's basically two dimensions we need to take into account that indicate control of the underlying license, even if it is hosted by the supplier and not by yourself. Important to know, usually both indicators would need to be fulfilled, and you will need to do the exercise at the start of the contract or at the time of a modification of your contract. So the first one, we'll go more into detail here in a second, but your contractual right or possibility to take possession of that software during the hosting period. If you are having it hosted by a supplier, but that's just out of practical arrangements, if you can just transfer it to your own systems at any part of the hosting period, that would show that you do have a measure of control over the underlying license. The second indicator is contractual right or possibility to direct a modification of that software. So if the supplier has granted you leave to adjust it, customize it however you want, that's also a really strong indicator that you will probably have a license on the underlying software. Now, on these two indicators, what we need to be really careful about is it a contractual right that is also substantive? Because if you start making up certain scenarios and you're looking at the detailed statement of works and the related contracts, what you often see is there's a lot of contractual rights and obligations for, amongst others, the hosting. So there's a general consensus that you need to have a substantive right, and that is the ability to take delivery of your software without incurring significant costs. And those significant costs are really something that should be taken in the more broader sense of the word. So not just financial costs. Even in certain contracts, you will see significant financial penalties. If you want to take possession of the software, okay, there's a contractual option for that, but you will pay a fee of 1 million euros. Okay, that might be a significant disincentive. But it might also be under the arrangement that you're paying a hosting fee, for example, 100,000 euros monthly. But if you want to transfer it to your own systems, then you will have to pay all the unused hosting fees, or a big percentage of that. So you need to really take care, even if there's a contractual option, that does not mean it is substantive. Also, if you want to take possession of that software, you want to run it either on your own systems or on another party, third party, as a replacement, let's say, you need to check if you have the technical capability to do that. I mean, it might be that you need to take a lot of new hardware investments on. If you have to build a fully new server, yeah, that might be difficult. You might also need very specialized IT personnel. And those are just investments that are making it a lot more difficult to say we have a substantive right. Same for the third-party replacement services. Other parties they will always say, sure, we can host something, but they need to be able to do that. If the software is really specialized or needs a very specialized operating system on that, it might not be as easy as it sounds. So you need to really assess all the different items there, even if you're, for example, if you go into details and everything here checks out, but you've used the system for 2 years, and if you transfer to your own system, you don't, or you have a very lengthy process to transfer all the data that you need, and that's going to take multiple months to transfer all the data from your supplier to your own systems. That's also really big disincentive. So be very careful when assessing these type of contractual arrangements. A second indicator that your right would not be substantive is if you do have the ability to use the software in your own systems, but there's a significant decrease in the value or the utility of that software. So, and that might just be other types of restrictions done by the suppliers there, like the original supplier who says, okay, but if you're hosting it on your own systems, you get a local copy, but we're not going to be providing any further security updates, for example. Or if there's something wrong with one of the functionalities, we're not going to be working on it further. So again, that would not be a substantive right if he has those types of restrictions. The second contractual right, or the possibility you would need, is to direct the modification of the software. So again, here, is it a substantive right? I think most of the contracts foresee in updates. For example, you will all know the update process, but if you do not have any say in how and when the software updates are being done, that would be a really strong point in favor of the supplier having control over the underlying software. The inverse would also be true. If you as a client have the undeniable right to say no to all the updates because you don't want to upgrade certain other systems that are linked to it, that is a strong point in your favor, let's say. Maybe useful to know, the general consensus here is that if you have a possibility to defer the updates with 2 weeks or 30 days, for example, that is not considered sufficient to show control over the modification of the software. So you really need to have the unconditional right to stay on your current version there. Of course, modification of the software is broader than just software updates. Implementation of custom features or integrations with other business tools. Again, the same here. The supplier might have given you leave to integrate it and to write custom items into the source code all you want. Then you can show that you control the underlying software, but often it is not the case there. So be very careful again when you are trying to interpret these indicators. So software as a service, the main control indicators up until here, it's a bit of a judgmental process, I'll admit that, but apparently we needed quite some additional clarification also, because the license fees, and of course that is going to be the big bulk of a number of these contracts. Those are one thing. In a service contract, those would be expensed then. But if you're applying those definitions, there's a number of additional questions that were popping up in the years after the first agenda decision was published. And basically, everything then is on the implementation fees. All the fees you're paying for a software as a service to either customize it or tailor it to your needs. What do we do with those fees? And the answer is, okay, your accounting treatment, it will depend on the conclusion that you make first. Do we have an intangible asset there? You can bolt on to the implementation fees to the intangible asset or not. If you do have control and you have something capitalized under IAS 38, then the implementation fees would be considered as costs necessary to bring the asset into a working state. That's the typical conclusion for most items under IAS 38. So I would say these are generally included in the measurement and recognition of your intangible assets. If you do not have control, however, all the implementation fees for your software as a service contracts, they wouldn't really have a value without your access to the software. So logically, those implementation fees would also be expensed as incurred. However, and that's where the agenda decision makes some references and some really useful interpretations. Depending on the scope of the project, not all implementation fees would be equal. For example, and that's just your gut feeling, if you take a simple example here, you're doing the implementation and you're adding some additional code. In a number of the contracts, the additional code that is being written for your company specifically might be separable. So it might add functionality that is owned by you. Depends on the contract again. Do you have the underlying IP right for that new functionality, or is that still within the company or the consultant that has written it? But in some cases, you will own a part of a new functionality. And in that case, even if your software as a service, if it's a service contract, the functionality might be adjusted to work with other software, so you might own an intangible asset there. Now, so the conclusion is not as simple as it sounds beforehand, and this is where it comes a little bit more difficult in the IAS standards, because yeah, there's a lot of different processes before a go live of a new ERP system. Like if you implement SAP or another a new consolidation tool. You have all types of people working it, consultants, suppliers. Unfortunately, IAS 38 does not really provide guidance on how you should separate all these types of implementation fees. So the logical response that they made is, okay, you will probably need to develop an accounting policy how to account for these types separately. How will you distinguish between the different components of those implementation fees? Now, fortunately, IAS 8 on developing accounting policies also mentions that you need to consider the applicability of the other IFRS standards. And of course, those of you who have followed our previous webinars will know IFRS 15. We've talked quite a little bit on that. We also have a lot of guidance really there on how we should tackle this. So what we would really try to do, and I'm not gonna, I have 1 or 2 slides on this because I don't want to distract from IAS 38, but it's a step in between that you really need to account for it. So I'm just going to keep to the basics here, identifying promised goods or services in a contract. We will try to follow the basic IFRS 15 guidelines. Ideally for this, of course, you will have to dive even deeper into the contract details because you'll need to do an analysis based on the statement of works that you have, either for your own internal ITers who are working on the implementation, the cloud provider who is, depending on what he promises you in types of work he will do, or third-party consultants who are implementing the software of someone else at your firm. So basic guidance here would be on the implementation fees, do we have distinct promises? A good indicator is always if the service is readily available. So if it's also sold separately, for example, or by another third party, it would generally be capable of being distinct. Now, just because it's capable of being distinct does not mean that it's also distinct or separable within the context of the contract. So the best example here I might give is significant modification and customization, or really the integration of the different ERP modules that are being set up at a firm. So we could say that every module that we're buying from a single supplier is one single promise, and it needs to get installed and then configured. But to be honest, for these types of items, all the different models should be seamlessly integrated with each other. And the basic conclusion here, if you have combined all these different little modules, the combined whole may be substantially different or much more useful than just the sum of the underlying promised goods or services. So if you combine all the little types of modules, we get one set of comprehensive ERP systems that can be used. So a one-stop solution for all our data needs, let's say. And depending there, yeah, if you have a software supplier that is just providing us the one-step solution of the one-stop solution for everything, I would say that is a single promise. But of course, you will need to go through the process here. And again, I would say, try to look at it from both sides. If you're not sure on how to account for it, is it a single promise or not? Just try to think, what would my supplier be doing? Is he accounting for this as a single performance obligation, or will he be recognizing revenue for multiple performance obligations there? So again, always useful to look at it from both ways. What is a very important distinction here is that there's a big limitation here also. IFRS 15 guidance, it should be applied at contract level. So that does imply that you need to be very careful if you are buying services from unrelated third-party specialists. Like we have a software supplier, but either we're doing the integration ourselves or it's a third party. It won't be feasible to say, okay, even if the third party is performing a seamless integration with our own systems, we would not be able to say that it is within the same contract, because those are really different contracts. unless there's some type of the third party is acting as an agent of the software supplier, be careful that you don't make this mistake. Now, I think IFRS 15, if we have applied the guidance, if it's distinct and separable within the context of the contract, then we're just going to go to the next steps, and that's basically allocating the fees to each component in the contract. So based on standalone selling prices, you all know the model, but in that way, we would need to try to separate all the parts of the implementation fees and review whether we need to account for them separately. So here, some typical examples of these implementation fees. What types of different services or promises should you be looking out for? The first was already mentioned by my colleague here, Lieselot, research costs. If there's a third-party firm and they are really there for a gap analysis, they are assessing what you need as a company, they're making proposals on vendor choices, on what software to use. It's really a bit of a strategic choice there. And generally, we just consider these as research costs as any other. So we would tend to expense these as incurred. Also, in the preparation step, very often the software as a service needs additional or new data. So you will need to convert part of your data to work with the new system. And here it depends on the solution you choose, I think, because if it's a separate software component to manage your master data, that's probably a license that is separately identifiable. You have control over the underlying license, so that's an intangible. But if we're talking about, I'll call it legacy cleansing, so cleaning your data, manual work on your data conversion, you need to reconcile the new figures to the old systems, you're cleaning up records that were not balanced or that are still in Belgian francs instead of euros and all that type of stuff. Creating new dimensions really just for your reporting to work on the new system. Generally, that would be an expense and not a capitalizable asset there. So really all the preparation costs there, it's not really adding full functionality, so not capitalizable. Of course, what is also very important in your implementation and your customization fees is upgrades and enhancements. And those can be either to your own systems that you're adjusting to work with the new software as a service, but they might also be on just the software as a service that is being written by the supplier there. So the customization and configuration costs, it depends on what types of costs those are. They are typically linked to the license conclusions, I would say. So if you're capitalizing your license, the customization and configuration costs would also typically be included there as part of the cost, because you need those to work as intended on your own premises in the firm. Now, even if you would have to expense these, or if you're expensing the license fees, if those customizations really do create specific functionality where you own the IP of that bit of functionality, then you can always treat it separately and capitalize it. So very important that you don't just, that not everything is expensed there. You really need to do the exercise. Changes to the entity's own system, that's a bit more difficult, because usually you'll need a pretty good separation between your cost for maintenance and like minor upgrades, minor enhancements to your software. Usually those cannot be capitalized because they are not really adding any new functionality. Functionality here is really saying that, okay, the software can now perform new tasks it could not do beforehand. Now, in terms of the integration with the software as a service, the typical conclusion would be that if you're really going for seamless integration with the current software, that would be enhanced functionality. But really, again, it's a bit a management judgment there. Is it sufficient to say that we will have so much more use out of our old software just because it is linked? If you can start automating certain processes, then I would say yes. But if it's just adjusting two different links and you're pulling up some data just in another type of portal, then I would say, okay, maybe that's not sufficient to say, okay, the link we have made to our old systems is a new functionality. Also, try to check who is doing the customizations. If they are done internally, yeah, the internal guidelines to capitalize something are a bit more stringent, as Lieselot mentioned, than for something that is done by a third party. So try to really go through all the different steps there to make sure you don't forget anything. Testing. So obviously testing is quite important to know that everything works. Usually a lot of testing will also be done together with the software supplier. And it's also recognized as directly attributable costs of preparing your asset for its intended use. So usually the testing fees, you will be able to capitalize those. Training fees and maintenance fees, that will not be the case. So training, I think it's a general conclusion here, IAS 38. Training is really an example they are giving that you do not have control over that asset. It's maybe a resource, but it's certainly not an asset. So that will be expense. Same for just the ongoing maintenance. That's simply not sufficient if you're not adding functionality. And just in light of the last one, I want to remind everyone, once you have done the go live of a system and it's substantially complete, it's in use, typically you would not expect any further capitalization. Most of the costs you will be doing afterwards, I would think that those are just maintenance costs, except if you're going live in multiple stages and you can really show new functionality for different people, that would be another case. But try to keep this in mind. Once you have started your capitalization, it's on the balance sheet and it's finished, you're depreciating the asset or amortizing it, better said. Then typically we would expect that there are no longer any additions. So for us, that's really the big guidance there is. I've just recapped here the two different agenda decisions. So intangible assets, the customer's right to receive access to the supplier's software hosted on the cloud, and intangible assets, the configuration or customization costs in a cloud computing arrangement. I highly recommend that if you're doing a memo or if you have to decide on the accounting there, that you do look over the examples they have written there or the specific facts and circumstances that they are discussing there, just to see how your case translates to the final version that they have made there. So that is it, I think, for our main part of the slides. Do we have any questions?
Yes, so we have one question. So the question is, okay, probable economic benefits. Does customer retention with a developed software count, or do you really need to charge your customer for it? Yeah, I think for this question, I think as I also discussed in the beginning of the session, I think future economic benefits is more broad than only revenues from the sale of products or services. And so those future economic benefits can also be other types of cost savings or other benefits. So I don't know specifically what is mentioned with the question, but I think it's quite broad. And if you can, if you can show that you have those benefits resulting from that software, then it might be.
Yeah, I agree. Future economic benefits, they can be quite widely interpreted. So customer retention, like you would, I would say, it's almost as building a customer portfolio, like you say. But you really do need to take care that typically internally generated can be a rather stringent definition. So some of the items you're building yourself, you won't be capitalizing them internally, like your the brand you are building, customer portfolio, you have one. Typically, it will be valued under IFRS 3 once you're being sold, but you can't express it on the balance sheet because you can't sufficiently make the distinction between just the day-to-day operations and the customer retention there. So if you're really developing your software and it allows you to have more customer retention, it depends on the specific situation there. Why are you developing that software? And I think that tracks back to your question. If the customers are paying for it, yeah, even if they are paying for it, it might be an internally generated resource which we can't express on the balance sheet. So.
Okay. I think we also have a second question. So is a yearly impairment testing required for capitalized development costs when the 6 criteria are met for recognition?
I think it's a question that is IAS 38 general, let's say. There's no specific way you should treat those compared to other intangibles. So yearly, it depends. If you would have an indefinite lifetime, then it would need to be assessed yearly and tested for impairment. If you're just having the normal amortizations per year, then basically you only need to do an impairment test if there are indicators that one is needed. If it would be indefinite, but usually you don't see that for internally generated items, yes, but otherwise only if there are indications.
Yeah, so these were indeed the questions. If there would be any other questions also after this webinar, you can always contact us with your specific question and we'll come back to you on that.
Yes. Okay, I'll maybe just end on again the webinars that will be following in the first few months, and we hope to welcome you on one or multiple of these webinars in the future. We thank you for your attention and wish you a good afternoon. Bye.